So once again, guys, everyone, thank you so much for coming and very good evening to all of you. Today's session is going to be very interesting because today we are going to talk about the impact of the economic events and how it affects your trade, how it affects your investments. And the reason we are doing this session today because today was one of those important days when the one of the most important economic data came out, and we are going to see live what was the impact of that data on different currencies. Then we are going to understand what that economic data is, and we are going to go historically and see that how back in the last few months, last few weeks, when this data has come out, how it has impacted the other instruments also, right? If you have any questions around the session, during the session, and if you feel you need something, a little more clarity on this kind of information, please feel free to write your question and send a chat using your chat options, and I will be trying to answer you while we are live. If there is something which I cannot answer, definitely one of my teammates will reach you out. And all of you who have joined today have made yourself eligible for a free of cost one-on-one session, one-on-one training session later on if you would like to have. You can come to our office, we can connect over Zoom or Teams and whatever you like, and we can have a discussion about financial markets and how they move and what are the things which you need to keep in mind. So without any further delay, let's start and understand that how this actually works. So economic events or the economic data, as we see, this has a really important role to play um, in your portfolio, in your trades, because today's when we see the world as we know, it is very interconnected. So whatever happens in US or UK or in India, it does affect, like it does affect the stock markets, it affects the investment results. Now you talk about political decisions, you talk about economic shifts, you talk about geopolitical tensions. Every single thing which happens through international market, it will affect stock prices, it will affect the investor confidence also. Now for investors who are very risk averse, who do not like to take too much risk, it's really important to understand that how these kind of global occurrences, it will affect you, right? You have to recognize that how these kind of events and the market movements, it can have a positive or the negative impact. So you need to protect your portfolio, and whenever this news is coming in, especially I'm talking to day traders also here, uh, a economic calendar and a series of economic data which comes out throughout the month, it's like a bread and butter for a trader. So definitely traders need to watch out before they place trades at what kind of economic data is coming in. And as I said, we are going to go through live charts to understand the impact of this economic data. Now, obviously, there are different kinds of global events. There are political events. There are economic events which affect. So, we'll try to understand each event separately. We'll try to understand that how to analyze this, and at the same time, which are the events that actually matter, because there are so many news, there are so much economic data which comes out. So you have to understand as a trader which one is really important for you, which is the one which you must look at. And I think from the central bank policies to elections to inflation to employment, all of these factors are really important. So we are going to go one by one and understand. So first and foremost, we are trying to see that which are these economic data. So if you talk about political events, let's say if we are talking about US elections, we are talking about Brexit, like when UK took a decision to get out of European Union. We're going to go to live charts and see what happens. When we talk about geopolitical events, we're talking about wars and conflicts. When we are talking about natural disasters, we are talking about something like COVID or any kind of hurricane which comes in US. So investor sentiment moves on these kind of news, right? And it's really quick. I'm going to share a chart with you, so you'll be able to see that how normally the market moves. I'm going to take you to the live economic calendar also, but before that, let me show you something which which happened, and I think that should be yeah. So if you see this table, it shows the highlight. I hope everybody can see this. So look at the years and look at the impact on the US stock market index when that event happened. So starting from 2001, 9/11, we know the terrible attack which happened on the Twin Towers in 2001. And if you see this, the year it happened, in 5 days, S&P 500 was down by 11.5%. And it took just 1 month to recover that loss, right? And this is just the movement on that particular day. So around 9/11, you saw in 2001, markets fell down just in 5 days around 11.5% and recovered in 1 month. And if you see 2008 global financial crisis, the stock market throughout the year was down, and we are taking example of the US stock market index. So S&P 500, for those who don't know, this is a US stock market index which represents 500 companies of US. And we saw at that particular time, for the entire 1 year, it was down by 38.5%. It took 2 years for the markets to recover that. Talk about Brexit referendum in 2016. In 2 days, the index fell down by 5.1%. Took a week to recover that. And when we see pandemic, which was obviously very recent, 2020, I mean, it's been 5 years, but it still feels very recent. Stock markets fell down 33% in 1 month. So much terrible than the financial crisis. Entire 1 year, the stocks were down 38%. But if you see in pandemic, markets crashed by 33% in just 1 month. Took 6 months to recover it. This is just an example of what an global event could do. But at the same time, again, this was something which, these were the events which occurred. Obviously, the magnitude of that was very high. Uh, we are going to talk today about some economic data which comes out every 15 days. Some of them comes out every month. We are going to understand what is the meaning, and then we are going to analyze that when they have come back in the past, whenever they have come up with surprising numbers, how markets have moved, right? So I'm going to take you now to the live platform. And again, as I said, you have your chat options. If there is anything which you want to ask me, even about your portfolio, please do not hesitate. Anything which is related to financial markets, I may be able to answer. So just hit it with a question, anything which you feel you want to know. Meanwhile, let me take you to the live platform. I hope everybody can see this. So right now I'm sharing an economic calendar with you. Economic calendar represents the economic data which comes every day, not the same economic data. There are different kinds of economic data which comes on different days, but the impact of those data is very, very crucial on your trade. So we are going to start today itself. What has happened today, and I'm going to show you. So in economic calendar is something which is very important for a day trader, even for every investor, depending on how important the news is. So if you see, I hope everybody can see this. I'm going to zoom in a bit so you can see the impact. So one of the most important economic data is inflation. Inflation basically means increase in the prices over a period of time. Inflation, if it is too much, it impacts the economy. But if it is too low, it also impacts the economy. So inflation basically means the rise in the prices. Price should rise at a stable rate. If it rises too fast, that means the purchasing power of the people is high and they're demanding more and the prices are soaring high. What sounds like a very good thing becomes really dangerous when people below a certain income level, they're not able to afford something very basic. So we central banks, they ensure that they are trying to prevent too much inflation, but they are also trying to stop when the prices are going down too fast, because that leads to deflation. Now, controlling inflation can only happen by controlling the supply of money. So inflation basically means when the prices are going too high. Prices are soaring high because the demand for the product is higher. Demand is higher because consumer purchases have increased, and that can be due to excess of money which is there in the economy. And people are, so that could be because of businesses are expanding, there are more jobs, but that could be also because of the credit or the loans are cheaper. Because whenever a phase comes through when loans across the country are cheaper, it creates an environment where people can borrow cheap, invest, and make more money. And obviously, that leads to increase in the purchasing power. So, central bank to control the money supply to make sure that the consumer purchases or the purchasing power of the investors do not increase to a certain level. They try to increase the rate at which money is lent by the banks. So once the borrowing becomes expensive, it reduces the economic activity, it discourages the people to borrow more money, and it reduces the economic activity and controls the prices of products from rising, right? Now that decision, whether to increase the loan interest rates or decrease it, that depends on how much is the inflation. Inflation is measured through economic data, which is called Consumer Price Index or CPI. So this is where what we are going to see in this economic calendar. This is the economic calendar which you will find on Century Trader on our own platform, and you will be able to see this economic data here, and you'll be able to see what it is and how markets have moved whenever this data comes out. So today, 5:30 p.m., the inflation data came out. Now, if you see core inflation rate, when you click on this gives you a definition. So, what is the core inflation rate? The core inflation rate tracks the changes in price that consumers pay for a basket of goods, and that exclude food and energy. So, food and oil, because these are very volatile products. There are two kinds of inflations which are measured. One is the core inflation rate, which excludes the prices of food and fuel, and then there is inflation rate, right, which is based on the prices of food and energies. It is considered over there. So if you see consumer price index based on the prices of market basket of food, energy, commodities, we are talking about services, and then we are talking about medical care services. So we are trying to measure in US how much inflation month on month and year on year, how much it has changed. Now, how you read an economic calendar is, if you see the impact of this data is really high. So first thing what you should do in an economic calendar is, you just close this completely and you go to news and analysis, you click on economic calendar. And when you go on economic calendar, you will find a lot of economic data, but you have to eliminate the noise. So what you do, you scroll down and select the news which comes with a higher impact. Okay. And definitely the countries which you select, US is one of the most important ones. Then there is Germany. So the economic data comes from many countries, but most of the most important data which comes is from US, from Germany, from UK, and then again these days from China also, from the Euro area. So you select these kind of important countries right here, and then you'll be able to see that which is the higher impact data. So if you see now, there are two very important inflation data, which is core inflation rate and inflation rate. So if you see it here, the inflation rate has increased along with the core inflation rate. It was expected to go up by 0.3%. It has gone up by 0.1% more, which is 0.4%. So previously it was 0.2%, the last column, and now it has 0.4%. Same goes with inflation rate, which is month on month. 0.4% was previously expected was that it will be less, but it has gone to 0.5%. So this high inflation data, what does it mean for your trades? Now this data came at 5:30, so I'm now going to show you the impact of this economic data if you had taken a trade in gold, if you had taken a trade in euro, in dollar, yen, and I'll show you exactly at 5:30 how did this news move the market. So a higher inflation rate discourages central bank of US to make loans cheaper, because when inflation is high, you don't want to make loans cheaper because already there is higher inflation. If you make loans more cheap, people will borrow more money and inflation will only increase. So when inflation is higher, it discourages the Fed to make loans cheaper. In fact, they might keep the interest rates same, which is around 4.5%, around 4 to 4.5%. Now, this is really important. Why? Because businesses thrive on cheaper loans. That's why stock market reacts very sharply when inflation data comes high. So I'm going to show you today few very important data. So let's say I'm going to make a watch list right now, and I'm going to add gold as a commodity. I'm going to add US 500 index. I'm also going to add US 100, which is NASDAQ, and I'm going to show you why I'm adding this. I'm going to add US 30. Also going to add dollar yen, dollar as a currency. So because dollar also gets impacted when this kind of data comes out. So you're going to write Japanese yen versus dollar. I'm also going to write the peers with which dollar could be traded, euro versus dollar. And these are the topmost currencies, guys. So if you are ever looking for trading in currencies, these are the ones which a lot of people trade. Pound versus dollar. And I'm also going to show you the impact on Bitcoin, actually. Not that it is related, but then you see what happened around 5:30 when the news came out. So I'm going to put this. Also going to add, okay, I think that should be sufficient to see the impact of the inflation data on this. So I'm creating my list right here. And if you see right now, gold has jumped higher. So let's take it one by one. I'm going to start with gold, and I'm going to go to, so this economic data today came at 5:30. So I'm going to reduce the duration of my chart to 30 minutes so we can see the exact impact when the data came out right here. And if I make it 15 minutes, you'll be able to see much more volatility, and you'll be able to witness what happened. So look at this right here. This is 5 o'clock, 5:15, and then 5:30 right here. So all of you, just look at this. So this candle represents the price movement of gold. Around 5 o'clock, gold was 2,885. Okay. 5:15, it went down to 2,875, almost $10 to $12 down. And when the data came out at 5:30, it went down from 2,875, it went down to 2,862. And look at this big drop right now, 2,862 in 15 minutes of trading. But if you see, if I change this candle to 30 minutes, look what happened between 5 to 5:30. And this is really amazing. If you look at this, this was at 5 to 5:30. And then look from 5:30 to 6. So it went down all the way down to 2,862. But this candle has ended green. Why? Because it went to 2,862, and then again buyers entered, and it recovered back to 2,894 the very next moment. Just witness the volatility. 2,862, and by 6 o'clock it was already up to 2,895. $30 movement in 30 minutes. Look at the amount of movement which is happening today. And this is only in gold. You'll be amazed to see what had happened in a US stock market index. Look at this. This is US 30, represents top 30 companies in US. And the chart I'm going to show you, you are going to be surprised to see that how one news can have this big impact. Showing you 30 minutes. Look at this big drop. Look at this big drop. This happened exactly at 5:30. Dow Jones, which was at 44,582. Imagine this. So just for your understanding, I'm going to reduce the duration of this chart so you can see minute by minute. Okay. I'm going to reduce this down to 1 minute so that you can see what happened exactly at 5:30. So guys, this big candle which you are seeing right now, look at this. This is exactly 5:30. Okay. this big drop which happened exactly around 5:30. So from 44,500, in 1 minute it went down by $300. Look at this big candle. And right now it has continued to be. Look at, it came down from here and now it's here right now. It has still not gone back to 44,600. Look at this big drop. And that only happened because of the inflation data. Because stock markets react when inflation is high. Because when inflation is high, that means central bank will not be motivated to make loans cheaper, and businesses thrive on cheaper loans. So that data, the moment it came out, look at big drop, and then look at this, and now look at this sudden rise right here, 44,276 as we speak. This is one minute. Look how it goes up, right? That is why I wanted to show you the impact, that how quick it has fallen down, and then see how further recovery it happens, right? The day when this economic data comes out, it's an amazing day to trade, but obviously it's very dangerous also when you're trading. So you always need to calculate your risk before you get into this. Risk calculation is very important, because if you're not able to do that, if you just keep an open trade and with higher quantities, you can see that how volatile markets can be. You just saw that gold went down by $30 and bounced back in the very 30 minutes, right? So imagine how much it would move throughout the day when these kind of economic data comes out. And this is only inflation data we are talking about. And this is US stock market index. What happened to the tech index? An index which will track tech stocks. Look at this. This is NASDAQ right now. This is a tech index. I'm going to witness the same 30 minutes. Look at this. Look at the tech index. Again, if I select this a minute candle throughout, look at this. With this big candle. So if you see, even tech, which was around 21,725, it went down to 21,493, went down further to 21,440, and now it has already recovered to 21,600, already up by 200 points. So you see how volatile the economic data is. And now we are waiting for the Fed chairperson to come and testify and discuss more on what is expected, how the interest rates will be, what will be the path for the future interest rates, whether he's going to cut it, increase it, how the central bank of US is going to deal with this. So even on these kind of economic data, market moves a lot. One more important instrument you must see, look at dollar yen. Today, dollar yen has gone up by 1.3%. To a lot of people, I know these are numbers, but I'm telling you, currency in one day, if it is going up by 1.5%, it's a big deal. A lot of traders actually wait for these kind of movements so they can short the currencies after it has moved so high, because obviously people start booking profits on currencies also. So if you look at the chart for dollar versus yen, dollar obviously became very strong, because if inflation has come higher, which means there will be no rate cuts. If there are no rate cuts, that basically means that dollar will continue to remain stronger, because the supply of money, it will be again very less. There will be less liquidity in the market. So if I show you what happened exactly to dollar yen, look at this. Look at this big bounce. So what we saw right here for markets, which was red, look, dollar, it was at 152.81. It bounced to 154. If I select a 1 minute candle, you will be able to see how much it moved at that particular minute. Look at this. Look at this big candle. It's very distinguished, right? Look at this. You see this thread right now? That thread is the indication of how volatile the market was. Just went down and bounced back, right? So this was the lowest, again went to the highest, and then it has continued to go even much higher. So look at dollar yen right now. It has just continued to go higher, and it is up by 1.3%. Again, why is a currency moving up by 1.5% in one day? It does not happen every day. So this is something which you must see. That's why this economic data is really important, and you need to have a look at it. So while dollar became stronger, what happened to the currencies which were trading against dollar? So euro, for example, same. If dollar has become stronger, the currency is against dollar. If I see the same chart, again, I'm going to show you a 1 minute candle. Look at this big drop. This is exactly where dollar went strong, and euro, which was being traded against dollar, saw a big dip from 1.0367 all the way down to 1.0307, 67 pips down. Again, in 1 minute, that big a fall, not normal. So if you are on the right side of the trade, you could end up making a lot of money. But if you're on the wrong side of the trade, you could end up losing a lot of money. So that's why when you're trading around economic data, you really need to be careful. Read a little to understand that what is anticipated, what is expected out of this economic data, and it will really help you to understand. One very important thing. So look at Bitcoin. I personally feel that Bitcoin is not related to a lot of these events, but obviously the movement comes. Whenever the movement comes, we'll see what happened around 5:30 for Bitcoin. Look at this big drop, because these days Bitcoin is attached with the development of AI and blockchain, and whenever inflation is high, uh, investors, they dump riskier assets. So I'm sure today I'm going to tell you the relationship between inflation and tech, and this is something which you must know, that whenever the news comes out that inflation has increased, the first category of stocks which investors start getting rid from is technical stocks, tech stocks, because tech stocks, unlike utility, uh, they are not giving any dividends, right? Utility stocks, which are into coal, power, energy, they give dividends, so the investor can still hold on to it. But tech stocks, they don't give any dividends. That is why the investors, they dump tech companies a lot. And by the virtue of that, we see Bitcoin prices have also continued to fall. It was 96,400. It went down all the way to 94,150, $2,000 down in 5 minutes, 10 minutes of the economic data came out. And then again, it recovered back to 95,000. So it went down $2,000, recovered by 1,000. Now, if you see the logic is, if central bank does not reduce the interest rates, which means the lending rates remain higher. If lending rates remain higher, the investors, they will continue to invest in debt-based instruments. Imagine if you could give a loan to someone and get 4% interest. Why would you take that risk and invest into Apple or Amazon? You know you're not going to get any dividend. So that is the reason, when in the case of higher interest rates or in an inflationary environment, tech stocks are the first one to take a fall. Riskier assets are the first one to take a fall. And that's why if you see anything which is related remotely to tech takes a fall. So that's why we saw Nasdaq going down, we saw Bitcoin going down, we will see a lot of tech companies falling. A lot depends on what the Fed chairperson today testifies and the rest of the Fed meetings which are going to happen. So you see how indirectly Bitcoin also gets impacted by the inflation data these days, which comes across. So this is something which is really important for you to understand. And whenever this kind of economic data is coming out, you can definitely have a look at it and always see the impact. Now, I'm going to tell you a few more economic data. And also, before I do that, let me show you how this inflation data. So this is something which you can see only on the economic calendar, which Century Trader has. By the way, there are economic calendars which are available to you on Google. You can always search economic calendar. You can find which news is coming. But the impact of that news and the historical impact of that news. So we have a tool which is called event chart and price chart. So when you click on the event chart, it shows you some historical understanding that how this data has come before. But when you click on price chart, so price chart actually tells you historically when this data came, what was the impact. So today's 12th February, and I'm looking at Euro USD, for example. So 12th February, when this data came out, right here. So this is on a daily chart, which is a longer term duration actually. So it still shows higher, but if you see in a short term chart, it will look much lower. If you see 15th of Jan, this was the data, and after that, euro went up. If you see 11th of December, this was the data, and after that, look at the fall. Why I'm showing this to you, so you become familiar with the idea that whenever this kind of data comes, you can expect heavy movement in the trades. And this is all about inflation data right now. So this is, we are looking at all the currencies. Imagine Nasdaq. Now when I click on Nasdaq, look how the movement changes. This is data today, right? Just after data, it has come down and now it has started moving slightly higher. But if you see the data previously, this data came out and Nasdaq moved up. A data before that came out, went up, but continued to go down. 13th November, the data came out and Nasdaq was down. In October, data came out, Nasdaq slowly went up. September, this data came out, Nasdaq moved higher. And see how much it moves for the next 1 week after the data comes out. And this data was as per the forecasted. Forecasted was 0.3%, actual 0.3%. So it was in line with expectations. It supported the markets and markets went up. This is something which you can always see. Next is volatility also. Look at the volatility. If I select 15 minutes after the event, how volatile Euro USD has been. So you'll be able to see on an average 34 pips movement. But if I reduce this duration to 5 minutes, or let's say increase this to 1 hour, 1 hour after the event, average movement in euro is around 48 to 50 pips. That's a big movement just 1 hour after the event. So you'll be able to see this kind of historical impact on the economic data. So guys, inflation data is something which is really important. You should not skip it out along with the jobs report, which is called non-farm payroll. Because central bank, before they increase the interest rates or decrease the interest rates, they need to know two things. One, most important, how much is inflation? Second, what is the status of the employment and the jobs in the country? Imagine during the pandemic when there was a complete lockdown, people could not get out, a lot of them lost their jobs. During that time, if central bank would have increased the lending rates and made loans expensive, how people would survive? So definitely they didn't do it. They cut down the interest rates because they realized that there are not enough jobs these days. So jobs data also is really important, and you can find out how much number of jobs have been generated in US, in government, in private, including farms, excluding farming industry, and you can find out the unemployment rate. You can find out how much wages have grown also. If the rate at which wages are growing is higher, that means inflation is also increasing, right? So that is also something, because higher wage rate means that it will add on to the cost of the product, right? So that increases inflation. So even that kind of news also creates a big impact, right? Now I'm going to take you to the jobs report, and you can have a look at it, that how jobs report impact uh, currencies and how does it impact indices. Just let me show you on the economic data. Jobs report comes in a form of, which is called non-farm payroll and unemployment rate. I'm going to take you here, and please, during that time, if you have any questions, you can definitely ask. Today is 12th of February. Last Friday was, so jobs report comes out the first Friday of the month. And as you can see, 7th of February was the first Friday. And that is when the data came out. I'm going to show you here non-farm payrolls. I'm going to click on non-farm payroll so you can read what it is. Non-farm payroll is a report which is released monthly, first Friday. It really affects US dollar, it affects bond markets, it affects stock markets. It's like an earthquake actually for a lot of traders. So the data comes from the Bureau of Labor. It surveys about, like, it takes a survey of businesses and government agencies, and they try to find out that how much the data or how much jobs or how many jobs have been generated. Industry data on employment, hours, earnings of the workers on non-farm payrolls. So this is really important, guys, because if you see uh, the number of jobs expected were around 170,000, it came around 143, less number of jobs. If you see unemployment rate on the other hand, which was 4.1%, it went down to 4%. It's good to have a low unemployment rate, right? There is something called consumer sentiment. If you see consumer sentiment, that how consumers view their own financial situation, right? Because that is how we get to know that how much confidence the consumers have on their own financial situations. And when the survey is taken, there are questions asked which covers different kinds of consumer attitudes and expectations, right? So this gives you an idea of what is going on with the consumers, how confident they are about their financial situation. And obviously, if you see in this case, the expected was 72, but the performance measure came 67, which means a negative, like a lower sentiment than expected. Now let's see what happened. So this is 7th of February, right? We see that the unemployment rate is less, so that's a good jobs data. But the non-farm payrolls, the number of jobs generated are lower than expected. If you see average hourly earnings, they have increased right here, 0.5%, right? Which means wages have grown. That is another sign of increasing inflation. So we'll see on 7th of February how markets reacted at 5:30 p.m. when this data came out. And we'll do the same thing. We'll go on the watch list, we'll open the watch list, and we'll go this time on 7th of February. So if you see right here, change this day to maximize the chart. This is February, right here. Now we are looking at gold first. Going to reduce this duration to 30 minutes and go back 11th Feb and then 10th. And this is 7th February. Now if you look at it, we're going to go 5:30 p.m. when this data came out. Look at this. So if you look at this, this is 7 o'clock right here. 1 o'clock. And exactly here. And see this. You see this thin volatile candle. Just look at this. I'm going to zoom this for you. So if you see this, this candle represents volatility. It just went down, moved up. It went down real quick to 28.50 and bounced back to 28.70. $20 movement in 30 minutes. And that was just after the data. So if you look at this right here, see this. 28.50 is the low, 28.70 is the high, and it was on 7th February 5:30. $20 movement at that particular time. And after that, 5:35, it moved up 28.80. It went up to 28.80. So 28.50 the lowest, 28.80 the highest. $30 movement between 5:30 to 7. In 1.5 hours, gold moved $30. It went down again, and then see how high it has gone, all the way to 29.40 also. Obviously a lot has to do with this, the trade tariffs coming in, but after the jobs data, we saw gold prices seeing the low and the high at the same price. So this is the impact, guys. And again, we're going to see what happened with the US stock market index. Let's look at US 30 when the data came out, and I'm going to reduce this to again 30 minutes. Go to 7th of February, 5:30 p.m. Look at this. Look how markets have fallen exactly around the data. Look at this. This is 6:30, 5:30. So 5:30 movement happened. It went low as 44,660, highest 44,800, $200 movement, and then finally when the data was digested, from 44,840 all the way down to 44,250, $600 dip on that day, because unemployment rate came lower and average hourly earnings came higher, which indicated that the inflation is increasing, which is bad for the stock market. So see the big dip which has happened after the markets. So guys, again, as I said, it really impacts what happens at the economic event. And if you see a non-farm payroll, for example. So economic calendar right here, and this is something which you can easily find. So you go on 7th of February and you'll see back in the time when we have seen, if you see the volatility chart for non-farm payrolls, look at this. To select stocks mostly, or let's say currencies itself. Let's take dollar yen so we can understand. Okay, this is dollar yen. Look how much dollar yen had moved 1 hour after the event. 100 pips. 100 pips movement in dollar yen after this data came out. If you see, 5 minutes after this data came out, in 5 minutes, the average movement of dollar yen was 70 pips. This is huge, guys. This is huge. For a currency trader, it's a big, big impact, right? Look the impact 1 hour after the event. So range from here to here, a low, and then this is one. If you see the previous events, look at the upside right here, 87 pips, true range. Look at the previous event. True range 107 pips, 107 pips, right? And this is something which, look at, this is where the event happened, and look at the big dip right here, 107 pips. Look at the event before that, 48 pips. Event before that, 200 pips movement. Why 200 pips movement? Look at the data. Expected was 140,000 jobs, but actual data when it came out, it was seen that 250,000 jobs were generated. Higher jobs, which means central banks are confident enough that they don't need to cut any interest rates because there are enough jobs. Everything is going fine. So dollar became stronger. And look at this. Look at this bounce. It is 200 pips, guys. 200 pips movement is not normal after economic data. So look at this big gap which has been. So that is why it's really important for us to keep a check on central bank meetings, keep a check on non-farm payroll, keep a check on inflation rate, CPI data which comes. And you can always keep yourself updated about when this data is going to come, because whenever this data comes, it creates a lot of chaos. So you can always check past economic data, and then, so today is 12th of February, for example. If you go tomorrow is 13th of Feb. We have already checked in all the high impact news. This is all the UK news, GDP data. GDP, as we know, it's a growth rate, is a monetary value of all the products which have been produced within a period. So if the growth rate of UK is slower than expected, we might see pound falling down. But if it is stronger than expected, we might see pound getting stronger against dollar. If you see similarly, there's an industrial production economic data, and tomorrow is going to be the producers price index for US. So today we saw the consumer price index, which is from a consumer perspective. When the things which you as a consumer is going to buy, it's getting expensive. From a producer's perspective, who's manufacturing, who's making, from their perspective also, if the inflation is coming higher, that means that inflation is overall high, because the producers, when the raw material becomes expensive, they will pass on that cost to the consumer, right? And that is how the product becomes expensive. Sometimes it happens that the producer's inflation is not that much, but consumer inflation is high. That could be due to extra tax added or anything else, right? But most likely we have seen if CPI is higher, PPI is also higher. So amongst consumer price index and producers price index, CPI is the more important data. So you must have a look on CPI data as compared to PPI data. That really helps you to place a lot of trades as well, right? Guys, if you have any questions, again, I know this is a bit technical, but this really helps you to place your trades. And again, since we are just doing one session today, there are going to be multiple sessions. If you want to have a one-on-one session, we can definitely help you out with it. One question coming in, lately I've seen reports and markets are not moving accordingly. So if US reports are negative, gold to dollar must move up. But now I see reports coming out and things are not moving accordingly. Why? So again, it's a very important question asked. So economic data, and I'll tell you the reason. It's a very important question. So it's been asked that normally we have seen that when US report is negative, right? Uh, the gold prices normally move higher, and this is based on the premises that dollar and gold has an inverse relationship. Now, I must tell you that that inverse relationship between dollar and gold, it's pretty much on the book these days, because earlier the central bank would only print currency as much as gold they had, and that was called the Bretton Woods system, which was abandoned in 70s, pushing US to decades of inflation. But that being said, yes, if why gold prices go higher when US reports come negative, on the assumption that poor US economic data would motivate central bank of US to make loans cheaper, and that would make uh, dollar more weak, and that would definitely make gold more attractive. Because imagine this, if the borrowing cost is going down, right, all of a sudden people are not really motivated to buy government bonds, right? Because if it is going down, the next bonds which are going to be issued, uh, nobody wants to buy bonds. They want to invest into riskier assets. That is where a lot of people would switch to stocks, right? Another reason why people would switch to stocks when the loans become cheaper, because businesses, they flourish during the lower interest rate on the loans. So gold moves higher, first of all, on the idea that people would switch to more riskier assets in order to get higher returns. Plus, gold is acting as a safe haven, right? Today, also, if you see, by the way, gold prices, which have already moved up to 2940, ahead of the inflation data, it already started coming down throughout the day, because it was expected that the inflation might come a little high. So gold already started dropping. And when the data came out, it was a positive data. So today, US report is not negative. From an inflation perspective, yes, it is negative. Inflation is going up, but inflation going higher means central bank would keep the interest rate same. That makes dollar more stronger, right? uh, Gold right now, which has already corrected, before it came down from 2940 to 2862 today. So gold already fell down on a stronger dollar, but gold is moving higher in a different direction due to many reasons. One of them is the geopolitical issues. I think today Israel has announced that if the hostages are not, if they do not get free, then the ceasefire will stop. The war might start again. Then there is a massive buying of gold by central banks from China and Russia and others. So, and there is a lot of uncertainty. So, gold prices are going up on a very different news, not just the central bank. So it happens sometimes under different conditions. We might expect that the economic data versus dollar versus gold may not react in the same manner. If you want to see the most raw impact, instead of gold, you must see dollar. So today, if you saw that the inflation data came high, which means that central banks will not be motivated to reduce the interest rates. So if you see at that very moment, the dollar became stronger, it just shot up. If you see euro, you see pound, any currency which was paired against dollar, it dropped. So the best form of connection of any economic data which you see, if you look at that particular currency, it will react most of the time accordingly. But when you look at commodities like gold, there can be multiple reasons that why it would move in a different direction. I hope that answers your question, but you can always keep tracking. Sometimes when the surprise is very high, like today, the inflation surprise was really high. It was, and we saw that dip in gold from a quick dip from 2880 to 2860. So we really saw that big dip, but then again it bounced back. Uh, Another follow-up question on this: that in that case, should we not just rely on technicals? Absolutely. See, technicals and fundamentals, these are two very different uh, uh, areas of school, right? One thing which I have seen personally and would like to share this, that how fundamental and technical gets connected. On a fundamental news, when something falls down, and if it has fallen down on a support level at a technical perspective, it normally bounces back. So today, if you see gold fell down to 2860, if you look at your chart, 2860 is a technical support for gold. So it bounced back from there. So you can sometimes mix fundamentals and technicals together. You can see the fundamental report that why it fell down, but while it is coming down, and if you want to go on a buy, you buy at support levels rather than buying at the mid. So I would not be, even when I trade, I rely mostly on technicals. But something which is as important as a CPI or as a jobs report or a Fed meeting, that will have a lot more weightage than the technical. You can use technical to enter or exit. So today, when gold fell down from 2890 all the way to 2860, that was a good buying at 2860 because that's where the support was. Had it broke 2860, it would go down to 2854 and further down to 2834, wherever the support levels were after that. So you can mix fundamentals and technicals, but then you have to be, it works well. But fundamentals, when I say, you are looking at the very important economic data. So the ones which I'm discussing right now, these are the most important economic data. After this, there is industrial production, housing data, construction permits, and all of that. But the most important is what we are discussing today: the CPI, the jobs report, and the Fed meetings. These three are the ones which are really, really important. So you must look at that. You look at the fundamentals, you see that the prices are moving, and once the dust settles, the support level comes in. Use your technicals, enter at the support and exit at the resistance. You need to try that out. It worked out today actually. Gold, when it fell to 2860, which was a support, and then bounced back. So you can always try that out. And thank you so much for that question. Actually, it's a very lucrative question, and when I say lucrative question, it comes with a lot of opportunities actually, because it's a very important school of thought. Should I go fundamental? Should I go technical? See, as a day trader, technical analysis is important because you're not looking at whatever central bank is going to plan. It's going to be next 5 or 6 months of an understanding. But even as a day trader, whenever a non-farm payroll data comes out, whenever a CPI data comes out, it does influence a day trader also. So that is why this session is for both somebody who trades every day, somebody who's a long-term investor, because the magnitude of this data, it is going to last for a few days or a month or a week until the next Fed meeting comes in, or until the next inflation data comes in, right? Because this is something which is measured month on month. So maybe next month when the inflation data comes out, it tells you a different story. So most of the time, day traders, you rely on technicals, but whenever this data comes out, you must have a look at that. Right, guys? So if you have, this is something which I wanted to share. I want to share one more important economic data, and this is related to crude oil, actually. I don't know how many of you trade in crude oil, but before we leave, I really want you to have a look at this. Crude oil is a very important commodity, and there is something called crude oil inventories, which come out. And crude oil inventories come out most likely, most of the time, it comes every Wednesday. So let's say, for example, last it came was select. Yeah. So to see the crude oil inventories, you must change from high to medium. I mean, you select high and then you select medium also. I think today is also 12th of February. It's Wednesday. Okay, it's the data has come today also. I think around 7:30. This data is already out. So crude oil inventory basically tells you the weekly change of the crude oil supply. So there are crude oil inventories which are kept in the U.S. oil reserves. So how much inventory has been withdrawn, and that shows an idea of whether it is in excess or whether the inventory is less. So if more withdrawal means, again, more demand, less means less demand. So today, if you see, even this is gasoline and this is crude oil. So if you see, expected was 2.6 million and actual was 8.6 million. Big difference. Let's see what happened to crude oil after this data came out. not added this. So crude oil West Texas, which is the US crude oil. And if you see at 7:30 when this data came out, I'm going to show you exactly, again looking at 30 minutes charts, maybe give us more information. Look at this, 7:30 right here. It was at 72.61. It went down 40 pips, 40 cents. If I select 1 minute duration, as and when the data came out, look at this. Look at this, guys. This was 7:30 right here, 7:50, 7:40, right here. Yeah, look at this, 7:30 when it was 72.5. It went down in the next 3 to 5 minutes, almost to 72.3, bounced back. Now see, this is to the gentleman who asked about fundamentals and technicals, right? See, we got the data excess of supply, right? So that means the prices dropped, but when they dropped, they were likely to drop as per the economic data. But when they dropped, they bounced back from the support level, right? And again went up to the resistance, again came down back to the support level. So in this case, the fundamental and technicals both are playing together. The economic data comes out really sharp, the oil falls, but when it falls to the support and then bounces back. And now see, if you see this, it is kind of breaking this support. We are looking at a very 1 minute chart, so it's very smaller duration, but look at the volatility which is happening around this chart. So if you were to place a trade, you could use fundamentals and technicals together. And that is how normally we are supposed to see this. Lastly, I've talked about commodities, currencies, what are the important economic data. I want to talk about, before we leave, something which is related to stocks. And a most important economic event with a stock is the earnings season. Earnings season is the time when the stocks or the companies which are listed on the stock exchanges, they share their financial results. They show how much earning per share they have generated and what is the revenue they have generated over the last quarter. That revenue and earning per share is compared with the analyst expectations. And they also talk about their future guidance in the next quarter. What are they expecting? Now, I will show you one chart before we leave, and that will be of Netflix to show you that how a stronger earnings data can influence the stock. So, okay, let me show you on a different chart here. So just have a look at this, right? Look at Netflix. It is $1,000 per share right now. And I want to show you this. So 21st of January, after the markets closed, Netflix was supposed to show their financial results. And the earnings always come out either after the market closes or before the market opens. And here, when the market closed, Netflix was $860. Okay. Earnings came really positive. The results are very good as compared to the analyst expectations. They outperformed in their earnings, their revenue, their future outlook. And next day, when markets opened, it opened at 994. So from closing at $860 a night before, next day Netflix opened at a gap of 990, $140 bounce on the day of earnings. This is the impact. Guys, if you want to trade stocks, there is no better month than the earning season, and it happens every quarter. So today, this time it is obviously January, Feb, and then it will happen April, May, and then it will happen July, August, and then October, November, and again January, Feb. So this is the time when a lot of these companies, they show their financial results. We have a very good strategy, something called price action analysis, which helps you see the trend post earnings in last 10 years, that how when the earnings have come out, how the stock has moved. And this is something which we can definitely share with you. So a lot of these economic data, guys, it really impacts your portfolio. And it is really important that you must get familiar with these kind of economic news and impact, and how it can really bring a change to your investment strategies as well. So thank you so much, guys, once again. I think maybe the session is a bit technical, but the follow up of this, anybody who likes to discuss more can reach me out one on one. Just talk to your relationship managers who have assigned you for who have signed you for this session. And I'm more than happy, because you have attended the session, you're eligible for a free of cost session. You can come to our office, have a Microsoft Teams meeting or a Zoom meeting, and discuss more about how the economic data can impact. We can also share with you what should be your trading strategy during these times, and how you can actually use economic data and place your trades right, how you can combine fundamentals and technicals, because markets are really volatile and it's really uncertain. In fact, Trump being the president for the next 4 years, we might expect a lot of movement happening around. So the next 4 years are going to be full of volatility, full of insights, full of opportunities. So let's plan ahead, right? Let's just talk. I think even if you're a trader or not a trader, let's just talk and see how we can track these market movements. It's This is something which is really interesting, and it's a myth that it takes your entire day or takes your time. Not really. I mean, these days, whatever you are doing, you continue. You can always keep a check on prices, and this is not something which you have to look at your computer screens all day. It's actually in your hands how much involved you want to get. You can be a very long-term investor, a position trader, a swing trader, or a very short-term trader. It's really up to you. But you can pick your 10, 11 instruments, and you can just have a look at it and see how much it moves. And it's not really a rocket science. I mean, this is something which is really easy. So let's connect, let's talk. If you have any questions which you think that I will be able to answer better when we are sitting face to face, more than happy. Until then, thank you so much once again for joining. If you like the session, please go to Century Financial Google reviews. Do share your feedback. It really motivates us to continue keep doing these sessions. We are soon going to have a seminar in our Dubai office, and if you're based in Dubai, you can come and attend the seminar. It's going to be about investment opportunities in 2025. We are going to show you the live platform. If you have any questions, we can answer. So we are in a process of planning that out, and just be in touch with us, and we'll keep you posted. So thank you so much. It was a pleasure doing this session, and we'll be back next week with a different topic. The recording of this session will be put on our YouTube, so you can subscribe and definitely look at this session and the few other sessions which we have conducted on different topics. So once again, thank you so much for your time. My name is Yogesh, and I'll see you next week. Till then, have a really, really good night.